Hello, good afternoon, everyone. I welcome you all to the corporate tax session conducted by Spectrum. And thank you, everyone, for taking time from your busy day for attending the corporate tax session today. Let me introduce to our speakers today. We are having two experienced speakers for the session today. Mr. Balaram Vuchidi, who is the managing partner and founder of Spectrum Auditing, and he is a well-experienced person and having a big experience in Big Four companies. He's been conducting training sessions on corporate tax, VAT, and other related matters. Our another speaker today is Mr. Manish Saraf, who is a partner of tax and risk management services in Spectrum. He is also having a professional experience in Big Four companies and industry experience for around 20 years. He's also involved in various training related matters on taxation and other related matters. I welcome Mr. Manish to take forward now for the session today.
Thank you, Pratiksha, for the introduction, and welcome all. Good evening, good afternoon to all the participants. So we'll just run you through the key concepts on the corporate tax and the recent changes which has come in, or recent updates which has come in. And then, once we run through it, maybe you can ask your queries, list down your queries, and at the end of the session, we can take up those questions from you. So the corporate tax session, I know it is the corporate tax federal decree law 47, and then what we're going to cover in this section in the session is basically we'll cover about the background, why it came into picture, and then what is the tax base, and the most hot topic is qualifying free zone. What are those qualifying free zone, and tax losses, tax group, and then when someone has a foreign entity, how they can take a tax credit for that. And then the related party, intercompany, the owner's salary, what would it be, how much they should be charging it. We touch on such certain points, and then the transfer pricing, which is applicable for larger entity group. And then what is the documentation, the registration procedure, and administration procedure. So in terms of the background, why the corporate tax, if you see the last 5-6 years, the compliances in UAE has increased. There's one country to country by country reporting, which is applicable for large multinational enterprise having across the globe their presence, which is more than $3.15 billion dirham. For them, this reporting is required, and economic substance regulation for specific business activities. This notification and annual reporting is required, and value-added tax, you all are familiar with that, and the anti-money laundering for banking business and other gems and jewelry businesses are required. And now finally we have this corporate tax. So this, you can see over the last 5 to 6 years how the compliances has been increasing, and then the whole reason what this compliance is coming into picture in UAE, that UAE want to play as as an international benchmark, be at par with other countries, other geographical regions, not to be seen as a tax haven country where people are setting up the business to save tax. But now with the corporate tax coming in, it is also applicable to most of the countries around the globe. And with that reason, it has come into picture. So it brings in transparency, and then also when it brings in transparency, it brings in more investment, from outsiders. They see that it is not just for tax saving or tax haven. Then it plays in par with other countries around the globe. And if you see the journey, how it has been for the corporate tax, it started in last year, January, where the public consultation document was released. Then it came December last year, where the federal decree law was released. And then the frequently asked questions on this corporate tax by the FTA was released. And then thereafter, last 2 to 3 months, we have seen, and initially last few weeks, a lot of cabinet decisions and ministerial decisions has been coming into picture. So if we see, this is applicable for a financial year of 12 months, and it is getting implemented from 1st June 2023. But it has to be looked into it. What is your financial year? Which is, you have to look at your memorandum of association. And if you're, suppose example, like, if you have a financial year beginning 1st July to 30th June, so the first year of corporate tax could be 1st July 23 to June 24. And then for filing of return, there's annual return being filed, whereas in VAT you would say it's a quarterly return, but in corporate tax it's going to be annual return, which is 9 months after the end of financial year. So 30th June 2024 is the end of the year financial year. Then your 9 months thereafter is March 2025. And if see most of the companies would have 1st January to December, and also the C entity, like it would have the financial year commencing, the corporate tax commencing from 1st January 24 to 31st December 24, and 9 months thereafter becomes 30th September 2025, the return filing period. Now, sometimes some of the companies or some of the business entities want to change their financial year, the tax period. Then there are certain reasons which cabinet has come into given their decision is basically with respect to if the company is going for liquidation, or some company want to align with the tax group, the liquidation, like because you might liquidate, a company might liquidate in between the year others. It may liquidate in June 24. So the first financial, the financial tax period would be 1st January to June 24, or it want to align with the group. I know maybe you have a group company in India or other part of the world where the tax period is different, so you want to align with that, or come maybe align with the head office of foreign head office, and there has to be a valid commercial reason for any changes in the financial period. And it can be the application, it can be extended up to 18 months. The first period can be 18 months because you want to match up where you have a period of 1st April to March end, and you are currently following January to December, so you want to extend that period till March. So it could be more than 12 months, but it should not be less than 6 months. And this change for application should be made within 6 months of the financial year, or before filing it of return, so that you do, before you file your return, you have to make that changes, because that application of your taxable income and everything has to be computed based on the financial year. And for the financial year, you need to look at memorandum of association, which is filed along with the trade license. So if there are two categories for judicial person, it is natural or judicial person. Taxable person is judicial or natural, and it could be exempt or taxable person. So judicial person are mostly the LLCs which have a registered entity, and natural person is an individual or running a freelancing business. That could be also taxable. So here we have given example, categorize that. So if you see the one which are in white, like limited liability company, public shareholding company, private shareholding company, and free zone company, these are all like a judicial person, registered entity, where the owners are not different, are different than the business. Whereas if you see sole proprietorship or representative office, freelancing, these are all where the owners are not different from the business, so they are a natural person under the category of natural person. And in UAE, the geographical form, if you see, it is either in the mainland or free zone, or it could be in offshore. And free zone have, there are 40 plus free zone in UAE. So all these would be under the taxable compliance framework of UAE. So if you see the category, if we have the tax rate, it is a general category which mostly the mainland companies, and which would fall under like up to your income up to 375,000, business income up to 375,000, it is 0%. It is above if your business income is more than 375,000, then 9% corporate tax is paid. So the corporate tax is on the business income. And your qualifying free zone, we will look into detail about it. There has been cabinet decision on the qualifying free zone, where the qualifying income will earn 0% and non-qualifying will be 9%. But there are certain criteria to be met for qualifying income, which is further in detail slides. So overall, from the perspective of exempt persons, who are exempt persons, they are automatically exempt, which are government entities and government control entities, because they are doing for the public. The activities being carried out are non-profit and for the public, so they are exempt. And exempt if notified to Ministry of Finance, extractive business, non-extractive, natural, so oil and gas. These are already covered under different category of tax. Each emirate level tax is there, so they don't fall under corporate tax. And then qualifying public benefit entity. These are non-profit organizations which doesn't make commercial business profit. So these are, and cabinet decisions are listing out, there are certain non-profit organizations which can be formed, and those has to be listed down by cabinet decision. There are like around 130 plus entities which has been listed down, and time to time cabinet will update that. And exempt if application approved by the federal tax authorities. These are pension funds, social security fund, qualifying investment funds. So pension funds are for specific purpose. Similarly, social security fund are for specific purpose. So they also get exemption under the corporate tax. And qualifying investment funds are the one which are being traded in the security market stock exchange, because these are governed by separate regulations. So they are also getting exempted. And then those entities which are wholly controlled by those exempt category, government control entity, pension fund, qualifying, these also get exempted under the corporate tax. Now, a registration is applicable for all the entities, but out of these exempted categories, there are three categories which have been defined. There are government entity and government control entities. Then person engaged in extractive, non-extractive natural resources. These two categories are part of the exemption category, which are not required to be registered. But there's a third category, a non-resident person that derives only UAE source income that does not have a permanent establishment in UAE. That means a non-resident, say for a person who's based out of India and has a business in UAE, but he doesn't have a permanent establishment, that it doesn't have a branch or any kind of fixed setup in UAE, supplying those materials in UAE and getting through an agent. There's an agent who is an independent agent which will look into it. So he's deriving some kind of source of income. So and doesn't have permanent establishment, then it need not require to register. But the next question comes, will he be paying tax? What kind of tax? Because it is a source income in UAE. We will look into it whether he will be paying tax. There's a concept of tax credit, foreign tax credit, which withholding tax concept is there, which we'll look into it. Now, exempt person registration timeline, like there are certain timeline for different category of exemption, like qualifying public benefit entity. These are non-profit organizations. They need to register by 1st October. Qualifying investment fund by 1st June. A public private security fund by 1st June. Again, an exempted person controlled by 1st June. Like these have been timeline. By this timeline, they need to register. But what about others who like normal LLCs? What is the timeline for them? I mean, which is basically, it is before their first filing of the return. For others, it is prior to filing the first return, they need to register. Now, a natural person, now an individual or individual who's carrying out any kind of business activity, who has not formed any kind of LLCs, any kind of business entity, but doing on freelancing business, or like an individual who's having wages. These are categories which are the earning for them is exempted. Wages, salaried. Fortunately, we are fortunate that salary is not taxable here, so it continues to stand on the same point that it will not be taxable. Any bonuses or salaries being earned by the individual as a salaried person, as an employed in employment, will not be taxable. Then the personal investment is basically, it is made in your, someone invest in the security market, then the income earned on that is not taxable. And then the criteria for that is not conducted through a license requirement. You did not have to, if there is no license requirement or there is no license being taken over, and this, it is not applicable for them, then for those kind of personal investment, which falls majorly on the security market investments. Then even the real estate investment, if you have a property which is leased out in UAE and you are earning out of that, then for those also you don't, you're not taxable. If you own that property, the property is in the name of individual and is earning a rent out of it, it won't be taxable. And it doesn't require a license to carry out. And the other point which is mentioned in this blue over here is the natural person who conduct any other activity beside this wages, personal investment, real estate investment, and it exceeds 1 million, then it has to register and it is under the taxable criteria of corporate tax. Now, if you see the timeline which has been there for judicial person for registration, I mean from 15th May 2023, for public joint stock company and mainland private firms, LLCs, registration is open through the digital Emirat tax form. a digital platform where the registration can be done, and branch need not be separately registered. So branch would form a part of the LLC company. They need not do separate registration. And for the free trade zone, the date has not yet opened up for registration. So I think Federal Tax Authority will soon announce that date as well. And natural person also registration has not been opened up. But for natural person who are earning more than 1 million, they need to register whenever the authorities open the date for registration. As you have seen that, there is also a concept of deregistration. When you don't carry out the taxable activity, you need to deregister. So you need to apply within 3 months of date of cessation of business activity as a natural person. And when it is a judicial person, it can apply within 3 months, similarly, from the date of ceasing that activity. Now, this is an overview on taxability. Like this could be either resident and non-resident, and resident incorporated in UAE, and could be mainland and free zone, and also which are like incorporated, even like incorporated outside UAE, like they have entity in India or in Europe, but the person sitting out of UAE is controlling the business. The decision making isn't in UAE. Then that also becomes a taxable entity. And a natural person who conducts any kind of business activity, like consulting or any kind of freelancing activity, advisory activity, then that becomes taxable. And any other person which the government authority will time to time mention about those. And non-resident has a which it could be having a permanent establishment and deriving source UAE source income. So the income should be earned out of UAE and having any kind of relationship from the earning of source which is in UAE. That will be also under the taxable category of non-resident. So the tax base in terms of what is that tax amount, or what will be the tax base. So any income derived from for a judicial person, that is LLCs, any income derived from UAE will be subject to tax. Any kind of business you are carrying out, it could be in service or kind of distribution or trading business in UAE, which is being sold in UAE, it is taxable. And also it could be income derived from the rest of the world. As I mentioned that if you have a business in Saudi market, or if you have a business in Muscat or in Europe or in India, and the business is controlled out of UAE, then the income earned in that particular region out of, even though it is being sold out of UAE, that still become taxable when the decision making or the owners are sitting, or the main decision making authority are in UAE. And for natural person, what are those income which are, of course, the income which are being serviced in UAE, billed in UAE, these are of course taxable, but also the income derived from rest of the world. Now with the remote servicing, people sitting out of here and serving to any part of the region, Europe or India or Asia market, anywhere, if they are doing any kind of service sitting out of UAE, like software consultancy, they're doing it here, sitting out of UAE, or any kind of consultancy based in UAE and serving to any rest of the world, then that also become taxable. Then for this non-resident, there's basically 3 categories are there. It is a source income in UAE, as we discussed, or it could be pertaining to the permanent establishment and nexus. So if we talk about the source, is basically it is from the resident person. A non-resident, an Indian person, an Indian-based business is earning from a resident in UAE, that become a taxable, provided he meets the other permanent establishment criteria. Derived from another non-resident, it could be Indian person deriving from an Indian non-resident having a place of establishment, that is a branch office or any kind of setup in UAE, earning from that person will be taxable. And it is from the activity performed in UAE, asset, capital, like you would have a construction business for small, it could be temporary, but the assets are being located in UAE, then that become a taxable. Then for determining the permanent establishment, it's basically a fixed place of business in UAE, that is an office or kind of a branch, any kind of setup in UAE becomes a fixed place. And then a non-resident has habitually exercised an authority through another non-resident person. That could be like someone who's doing in garment or electronic trading from India to UAE, and he has appointed an agent to act on his behalf to sell or distribute in UAE, and that agent is only working for the non-resident Indian. So that way, whatever the income is earning through that agent, so that becomes being an agent, dependent agent on a, specifically working for a particular non-resident A, then that is kind of a permanent establishment. Or non-resident has any kind of nexus which time to time any kind of relationship with the source of income based in UAE will be taxable. So as I mentioned about dependent agent and non-dependent agent, this is a main criteria for non-resident. If someone who's specifically working for a particular non-resident a company based out of India, and so that is, if then those source of income will be taxable. And there could be independent agent. That means independent agent I is there for working for multiple non-resident. Then he's just earning commission from different non-residents. Then he's not a dependent agent. He's not acting under the direction of a non-resident. He's independent, working for multiple non-resident. Then it would be not tax. It won't be called subject to corporate tax. Because that independent agent will be taxable, not the non-resident. So the key point, to take away is basically to look at a legal structure. I mean, whether you have a setup in mainland entity or in the free zone, and look at your financial year, which would be there in your memorandum of association, from which year it is beginning. It is January to December, or it is April to March, whatever. Because based on that, the corporate tax would be applicable to you. Or even if you want to change, then there are certain criteria under which you can change your taxable period. And then, yeah, that resolution has to be passed to fix a particular. If you don't have clarity, then you can pass a resolution to fix that and update the memorandum of association for that. And then you need to look at what are the different exempted categories as we talk about natural resources extraction or non-profit organization or pension fund. There are certain categories or exemptions which whether you fall in that category or not. I need to check whether you have a foreign branch, outside UAE, how that will be taxed. And then, yeah, anything which is earned out of UAE. Another point which is basically what are the different kind of income which are exempted. Though you would be taxable business, LLC could be taxable, but the certain income which they're earning could be exempted. What are those? These are like dividend and profit distribution. Dividend and profit distribution, if you have made an investment in another company and you earn a dividend on that or a profit, then those are not taxable in the hand of receiving that person, because that profit is already taxed by the another company who's distributing that dividend or profit. Or income of a foreign, then we have the concept is dividend and other profit distribution received from participating interest. Now, participating interest is that if you have made an investment which is more than 5%, if you have bought a share or investment in any company which is more than 5%, and if you're holding for more than 12 months period, so, and that is in a foreign judicial person, like, if you're sitting in UAE, you have invested in US market or in any other, or in Europe or any other business, you have made more than 5% investment, and that investment is hold for more than 12 months, then the profit distribution or your capital gain from that is not taxable. And then income derived by non-resident person from operating of aircraft or ships are not taxable, because these are under the international transportation jurisdiction. And then the foreign permanent establishment, anyone who has a business in India or Europe or any other part, and he's earning a business from subsidiary out of that, then he has an option to apply for not, provided that the other countries should be also paying corporate tax, which should be more than 9%, then he can get an exemption from that. Then there are certain deductions which are applicable, like, the first is that deductible in the tax period when it is incurred. So you can only claim the deduction from which your corporate tax is applicable to you. So for the companies which has a financial period from January to December, the corporate tax would be applicable from 1st January 2024. So any kind of expenditure which are being incurred during that period of 1st January 24 to December 24, then those expenditure can be claimed first. And the first major criteria is that it should be wholly and exclusively for the business. I mean, it should not be a personal expenditure which is being incurred, can be claimed. Like for example, thin line when it comes for your vehicle fuel expenditure, which is being used for both business purposes or your personal use, or telephone expenses which are for both for business purposes and personal use, then it has to be documented well that how much portion you want to allocate for which are being used for business purposes, like 60%, 50%, whatever amount, that amount can be only claimed. Not capital in nature is basically because those are already under the claim of depreciation. You can claim, you're deducting as a depreciation expenditure. So any asset like you bought, you bought maybe a car, any kind of fixed asset you bought, or immovable property, movable items, whatever you bought as a capital nature, you cannot claim as an expenditure directly for deduction, but you will claim as a depreciation expense. And not related to any exempt income, like if you're earning dividend income, you have made investment out of borrowing the fund and the interest amount, you want to claim that interest deduction from your dividend. No, because your dividend is already exempt, it's not taxable. So other category of exempt income which is there, you won't be claiming any kind of expenditure which is incurred for earning that exempt income. Another expenditure as maybe time to time, it would be identified by the cabinet decisions. Now, certain expenditure which are not deductible, specifically listed out. First, as we mentioned about expenditure pertaining to exempt income, it won't be claimable. And then the other is interest beyond 30%, which is earning before interest, tax, depreciation, and amortization. So there is a cap of 30%, beyond which you cannot claim it. So if you look at this, this is basically about the net interest expenditure, which has been recently, the ministerial decision has been announced that suppose if you have earning of EBITDA is your earning is up to 100,000 and you have an interest amount of 50,000. So if you see if your earning is up to 100,000, your earning is 100,000, so 30% of that is 30,000, and you have interest amount of 50,000. So now this limit has ideally could have claimed up to 30,000 of 100,000. But now since this new cabinet decision, ministry decision has come in, which is allowing you to claim up to 12 million. So it can be your interest amount can be claimed up to either 12 million or 30% of EBITDA, whichever is higher. So in this scenario, when you have interest amount of 50,000, though your earning was 100,000, and with the clause of 30%, it was limited to 30,000. But now with this increase of 12 million, you can claim 50,000. And anything which remains not to be, if it is not claimed, you can carry up to 10 years, up to 10 years period, you can carry that interest and claim in the business in subsequent period. And now there are a lot of different categories of interest income which can be claimed. And I think almost all the categories of interest is allowed to be claimed as a business expense. Just going back again to this, the next is related party loans. Now a related party, like as an owner, you have given a loan, and the purpose of the loan is to withdraw dividend or any kind of capital distribution you want to make, which is not for the business purpose. So that interest, the interest earned on that related party will not be, the loan given by the related party will not be allowed as a deductible. But if we are able to justify with the commercial business sense that it is for the working capital or for business purpose, then you can claim that interest amount. But it has to be, again, arm's length principle has to be followed for whether the interest is as per the market rate or not. Then another clause, point number 4, is about the entertainment expenditure is limited to 50%. If you just quickly look at this interest, this is 50% expenditure of for the entertainment expenditure, which could be for your meals, for any kind of accommodations or any kind of admission or transportation fees incurred for your customers, shareholders, suppliers, or business partners. So it is limited for that. It is up to 50%, not beyond that. But now the next question comes: if this entertainment expenditure like team meal or team gathering is being arranged for your employees, will this be allowed or not? But yes, it has been clarified by the guidance note issued by the FTA, where it says 100% in that scenario can be claimed only for specific purpose, customers, shareholders, suppliers, business partners. It is limited to 50%. And then other part of the certain non-direct expenditure is non-business expenditure. Of course, if something which is for the personal, if you're having a travel expenditure for a personal purpose, and if you cannot claim those expenditures, And then fines and this other deductible fines, penalties like your VAT fines, penalties, anything which is coming in, or any kind of penalties or a traffic violation or anything, you cannot claim that expenditure because that is doesn't have a legal validity of a business expenditure. Then capital expenditure is basically you, as you have mentioned, that if you're buying an asset, you cannot claim that as expenditure directly. Buying a car or any kind of asset you bought it, like a photocopier machine, you cannot claim that as expenditure. You have to depreciate that. Then the other part is, so just a summary on basically the non-deductible expenditures are your, as we talked about, tax on income imposed. So any kind of tax income, foreign tax you have paid, taxes are not deductible. These are out of your business income you are paying a tax, so you don't deduct that amount. Or dividend or profit distribution, any company who's distributing dividend or profit, these are not an expenditure, but out of profit being distributed to the owners or the investors, so that won't be. Then amount withdrawn by a business, by a natural person, so an owner withdrawing any amount or any kind of amount just withdrawn from the business, it won't be, it's not an expenditure. So any kind of bribes or payment, illicit payment, of course, these are not business expenditures. And the other critical point is input VAT tax claimed. That means if you have not claimed any kind of input VAT, which is recoverable out of your output VAT, then those not claimed input VAT cannot be claimed as a deduction of expenditure, because the authority has already given you option to adjust against the output VAT. And this, I can give an example where, like telephone expenditure, where the amount of the VAT input VAT is minimal, you might not be tracking that. Or a fuel expenditure, the VAT amount is minimal, you won't be tracking that. So you have to start tracking those small amount and claim out of your output VAT. And then any kind of donations, grants, gifts, given, other than the qualifying public benefit entity, which the cabinet decision has listed down certain non-profit organization. If you make a donation or grant to those, then only. But if these are not listed out of that public benefit entity, then they won't be allowed as a deduction. And of course, the fines and penalties are not. But there is another clause which is there. Important part is that if you have a contract with a client and there is a service delivery clause, that if you have delayed that delivery and you have been charged some kind of penalty or for a breach of contract, then those are allowed, because these are not cases of which are not in the nature of fines or penalties, but these are like a business scenario, business justified cases where you have delayed the delivery and there was some breach of contract clause and you have paid something, that can be allowed as expenditure. But fines of a nature of delayed payment for VAT or any kind of tax regulatory or any kind of regulatory authority fines, then that won't be allowed as a deductible expenditure. Then the summary, basically we need to look at that, what are the incomes which are exempted, that we need to keep a separate track of it. What are deductible expenditure, what are personal expenditure, that need to be separately tracked. We need to have a policy on the asset capitalization, how that, because we cannot claim the directly capital expenditure, but a depreciation is claimed. And then the interest expenditure, the entertainment expenditure. So all this category of different expenditures are allowed, not allowed, and then limitation on interest amount or whatever. We need to separately look at it and define our chart of accounts accordingly. So now this is about the tax group. So the tax group can be formed, like right now the registration is open for all the company, all the LLCs company. They need to individually register it, but then they can form a tax group separately. So, and how the tax group can be formed, certain criteria for that. First is that it need to be judicial resident person, that is a LLC company or any kind of registered entity in UAE. Then it can form a tax group, provided it has a 95% ownership in his subsidiaries business, and there should be a parent and subsidiary relationship, and the ownership should be more than 95%. And it cannot be forming a group with a qualifying free zone or exempt person, because qualifying free zone has a separate, qualifying free zone are not taxable. It is 0% taxability. So the business cannot be combined with a company or with an entity which is paying 9% and the 0%. So a group cannot be formed with a qualifying free zone. A mainland cannot form a group with a qualifying free zone. And then the other criteria is that they need to have a same financial period, like January to December or April to March, whatever. That has to be same for the subsidiary as well. And then the same accounting standard to be followed. Generally, it is IFRS, and that has to be followed for all the subsidiaries and parent, because it will be consolidated. And then what is the impact of it? A single taxable person. That means the limit of there is a tax up to 375,000 now will be applicable for the group. Now individual companies, B, C, D, E, there are individual companies which are clubbing with the A company, A holding group. Then when they are consolidating, forming a tax group, then they cannot benefit from 375,000 individually, but as a group only they can claim once 375,000 up to 375,000 0% in corporate tax. And then the parent company has to do all the registration administration requirement. Then of course the consolidation has to take place, and the intergroup company, any transaction that will be knocked off. And then parent and subsidiary are jointly liable to pay a tax payable. Even the subsidiary can will be liable for the payment of the tax. And if during the year if any criteria is not met of forming a tax group, then they will be not part of the group, and they need to notify the authority. And even the parent can be replaced. If a parent is being taken over by another company, group company, and another holding company, then that can be also replaced in the application to be part of the tax group. And then there's a concept of tax losses. So if you have a tax losses, it can be carried forward, it can be set off from the future period. It is up to 75% of your subsequent period earning. And then, the important part is that it has to be, after your commencement of corporate tax applicability. So corporate tax is applicable from 1st January 24 to December 24. Then you cannot carry forward any tax losses of 2023. It would be only allowed for from the year in which it is being your corporate tax is applicable to you. And just an quick example on this is that suppose there's a tax loss in 2024 of 275,000, and then so in 2025 if you have an earning of 100,000, so the tax loss which can be adjusted of 275,000 of 2024 can be claimed up to 75%. So 75% of 100,000 is 75,000. Okay, so the balance 200,000 can be carried forward, and the taxable income for the 25 is 25,000. And similarly, it applies for 26 and 27. And for information, tax losses can be carried forward for indefinite period. There is no time limitation up to which it can carry forward. You can carry forward until your business is being continued. Then there is another concept of, this is a qualifying group, which is basically a judicial person, resident person, holding, even if you are not able to have a 95% stake, but if you have holding, the holding company has 75% ownership interest, whether direct or indirect. And again, the same criteria of not being an exempt or qualifying group, a mainland company cannot form a qualifying group, with the free zone company, which is a qualifying, which is exempt or which is paying 0%, same financial period and same accounting period. And the tax losses can be carried forward is basically similarly up to 75% of the taxable income of other entity which is forming a qualifying group. Common interest of 75% can be claimed. So here is an example to this. Suppose there's a company A and company B who has a common stake of 75% in between, and the revenue of company A is suppose 2 million, and then there's a tax after tax law deductible expenditure, the tax loss is 550,000. So out of 550,000, if you see, the company B earns 600,000. So 75% of 600,000 is 450,000. So the tax loss of company A, 550,000. Out of that 450,000 can be adjusted from company B. And then see the net law, the after the taxable income from 600,000 minus 450,000, adjusting the tax loss of company A is 150,000. Now there won't be any taxable for 150,000 because it is below the 375,000 threshold. So up to 370,000 is 0% tax. So on 150,000, the tax loss is the tax payable is 0%. It is nil. So now the next point is regarding the withholding tax and foreign tax and other points, which my colleague Mr. Balaram will take over this. So Balaram, handing over to you.
Yeah, just to continue a few more concepts relating to the decree law, but yeah, soon we'll get into the free zones. Thank you, Manish. And we'll just look at the withholding tax. This is a tax that is paid or deducted by the companies in UAE against the transactions that are done by the non-resident companies. The company from outside UAE is providing some service to UAE company. If that company is not a resident here, So the UAE company is expected to deduct a tax which is called as withholding tax and then pay net amount to that supplier. The withholding tax that we deduct is supposed to be paid to the government. But at the moment, the withholding tax rate in UAE is 0%, but it can be increased to any rate higher than 0%. Not only this, withholding tax credit also is given for a non-resident person, not for the local ones. If a non-resident person, if he is subject to UAE withholding tax and later he becomes a taxable person and thereby he is payable some UAE corporate tax amount, then he will get a credit of this withholding tax which is already paid in UAE, and then he'll have to pay net amount. So that is about withholding tax. Foreign tax credit. So any tax that we have paid outside UAE, maybe on your permanent establishment, like in a branch or any other representative office outside UAE, and that income of the branch is subject to tax outside UAE. And also, because it is a branch, so it is going to be part of your UAE income. So here also, if you are going to pay the tax, so whatever tax you paid outside UAE on that branch income, so that amount you can claim as a credit here against the tax payable in UAE. Of course, there are certain conditions to be met. So once you meet those conditions, then you'll be able to get the credit of that. So it's not only the tax that you paid outside UAE on the profits, but also the one which I told you about withholding tax. So similar to what we have in UAE, in other countries also, they have some withholding tax rules. So let's say a company in UAE is providing some services to a company in Oman worth 100,000 dirhams. And in Oman, the withholding tax rate is 10%. So the Oman customer, he will deduct 10% out of your 100,000 and he'll pay you only 90,000 dirhams. So this 10,000, what he deducted there is a withholding tax, which is nothing but for us a foreign tax. So if this rate or effective rate is more than 9%, or if it is less, then whichever is lower, can be claimed as a foreign tax credit in UAE when we pay our tax in UAE. So far what was happening is whatever withholding tax that Oman company was deducting was not allowed as any other credit. We were not getting any benefit out of it. So it was an expense or a loss for us so far. But once we get into this corporate tax regime, the tax that we pay outside UAE, so some portion of it we would be able to get as a credit. So let's quickly look into one small example just to understand the concept. Let us say a company has got a revenue of 3 million dirhams in 24. Out of that, 2.2 million is expense or allowable expense, and then you are ended up with 800,000 as taxable income, on which if you calculate the tax by considering 0% up to 375 and 9% in excess of that, so you are end up with a 38,250 as tax payable amount. Let's say you paid foreign tax amount of like some tax you paid outside UAE, the rate is about 5%, and then the amount paid was 10,000 dirhams. So what you will do is that out of 38,250, which is payable as tax to the government here, so this 10,000 will be deducted as foreign tax credit, and you will end up in paying only balance amount of 28,250. Of course, you need to have documentary evidence to prove this, and then there should be a rate, effective rate, which is more than the 9%, or if it is less, then the lower of both will be taken. So this is how it works. So let's get into the most important concept or topic with respect to the decisions. So cabinet decision number 55 as well as 139. So this is with respect to the free zones. They have given few rules with respect to free zones as part of the decree law already, but there are more rules given with respect to free zones as part of the decisions later on. So this presentation or these slides that we are going to talk about, it includes both whatever was given in decree law as well as the points given in the decisions later on. So these are the conditions that we need to comply with if you want to be qualified as a qualifying free zone person. We have seen in earlier slides that if you are a qualifying free zone person, that's when you are eligible to get 0% tax benefit on your entire profit. So let's see what are the conditions that you want to meet to be a qualifying free zone person. The first and foremost thing is to maintain adequate substance in the state it was mentioned in the decree law like a state, but whereas if you see in the decision, so it is clearly mentioned as in the free zone. So the substance with respect to your business size should be maintained in the free zone to be able to consider it as having adequate substance in the state for the purpose of qualifying free zone person definition. So what do you mean by adequate substance? So the adequate substance means the first thing is that you should be able to undertake your core income generating activities in the free zone. Means whatever income you generate, whatever is your main business, so that should be happening in the free zone. And to the size of the business that you are claiming, so you need to have adequate assets, adequate number of employees. You need to be incurring good amount of a sufficient amount of operating expenses in the free zone to the size of your business. So when I say to the size of your business, let's say that company A is claiming 100 million as their business revenue in a free zone for a company. So to be able to have business size of 100 million turnover, so what is the asset base that you need to have to be able to do this size of business? How many number of employees are required to be able to do that size of business? And are you incurring sufficient amount of expenses to be able to conduct the business of 100 million turnover size? So that's what they are trying to tell you, that when they ask you to maintain adequate substance, you need to be in a position to demonstrate that you are maintaining sufficient amount of substance in terms of these KPIs or these indicators. That's when you are called as meeting or maintaining adequate substance. Thereby, this is one of the conditions that is required to be a qualifying free zone person. Second point is to comply with arm's length principles and transfer pricing requirements. Whenever you have any transactions with your related parties, as well as with your connected persons, whatever documentation as well as other compliances that are required to be able to comply with this arm's length principles as well as transfer pricing requirements, so you should comply with them. So if you are able to do that, that's when you will be considered for qualifying free zone person. Not only that, you are not supposed to elect any option given to be considered as a full tax regime, or as there is an option given to the free zone companies. If you want, you can select yourself to be considered as if you are a mainland company. Means you can opt to be subject to corporate tax at 0% up to 375,000 dirhams, 9% in excess of 375,000 dirhams. Did you opt for that? If you opt for that kind of option, then you will not be considered as a qualifying free zone person. So one of the conditions is that you should not be opting to be considered as a person to be subject to tax at full taxes or full taxation. So that is also one condition. Other condition and main important condition is that you should derive qualifying income as specified in the cabinet decision. So this is what is being released recently, and we will go through the conditions or the definition given for qualifying income in the following slide. But yes, so you will be called as a qualifying free zone person only when you have a qualifying income. Okay. Otherwise, you will not be called as qualifying free zone person. Thereby, you will not be getting the benefit of 0% tax on your income. The subsequent point, and the last point that was recently added in the decision, was to maintain audited financial statements. So all the free zone companies, mandatorily, they should have their books of accounts maintained as well as audited to be able to consider for this qualifying free zone person definition. So this is another condition that is required. So needless to say that we all should maintain proper books of accounts as well as get those books of accounts audited properly. So now let's see what is this qualifying income definition, as well as just to refresh the rates given for qualifying free zone person and non-qualifying free zone person. So any free zone person can be a qualifying free zone person or can be a non-qualifying free zone person based on meeting the conditions that we discussed earlier. So if a company is not qualifying to be a free zone person, then the tax rates are going to be like your normal mainland entities rates, like 0% up to the profit or taxable income of 375,000 dirhams, 9% in excess of that amount. So that is the regular one which we all know. I'm sure. Now, the next thing is about the tax rates applicable for qualifying physician person. So let's say that you have met all the conditions we discussed in the previous slide, and you are now considered as a qualifying physician person. For you, the rates will be like this: 0% on all your qualifying income and 9% on non-qualifying income. So now when we say qualifying income 0% and 9% on non-qualifying, so now we need to know what is the qualifying income. So the next box talks about that. Qualifying income, where you have to apply 0% tax on them. So they mentioned 3 points in that. So you have to be carefully listening to that. Let me just read them out for you. Income from another prison person, except excluded activities. So you, as a prison company, you are generating this income out of your business with another prison person. Okay. Only exception is that those activities should not be falling in excluded activities. So there are certain activities which are mentioned as excluded activities, which we will see in the following slide. As long as you're not providing or doing those activities or performing those activities, and your customer is also a prison company, it need not to be a qualifying prison person, but as long as that customer is also a prison person, as like you are a prison company, so then that will be considered as a qualifying income. So income from another prison person, except excluded activities. So here the condition is that the customer of you who is part of the free zone, he should be the ultimate beneficial recipient. Means he is the one who is going to consume those goods which you are selling, or he should be the one who is going to take the service and utilize for his own business whatever you provide. So that's the one of the conditions that we need to comply or keep in mind. So you, as a free zone person, if you are providing services to another free zone person, or you're selling some goods to another free zone person who is the ultimate beneficial recipient, means he is the enjoying benefit and enjoying that particular service or using the goods for his own business, and these activities are not falling in the list of excluded activities, then your income will be considered as qualifying income. So that's first condition or first activity or income. Second scenario is income from qualifying activities from mainland person, non-prison person, or outside UAE person. Here also that term is there that it should not be part of the excluding activities. Let me just repeat. Income from qualifying activities, there is a list given. What are the qualifying activities? Provided to any non-prison person, which could be a mainland entity or outside UAE entity. For them, so whatever income you generate out of that particular activity will be considered as your qualifying income. So here one important thing that we need to see is what are the qualifying income activities. So you are a prison person, you are providing qualifying activities to any company. So which could be in free zone, or could be in mainland, or could be outside UAE. Okay. Free zone anyways we have covered as part of the first point. We are only now more worried or concerned about the other persons other than prison persons, like mainland entities or outside of UAE entities. So it will be considered as qualifying income only if you are conducting activities that are falling in qualifying activities. Okay, so there's a list given, which we'll look into that. Okay, so if you are providing services or selling goods to other than prison companies, then you should be only providing or performing qualifying activities. And of course, they should not be excluded activities. We'll look at that. If required, we'll also come back to this slide again, just to be more clear about the concept. The third condition, a third category of income is any other income which is subject to de minimis. What is de minimis here is non-qualifying revenue does not exceed 5% of total revenue or 5 million dirhams, whichever is less. So here in this, what they are trying to cover is only if you have other than above related activities income, but that is very minimal when they're given that limit of de minimis. So it is like either you have 5% of your revenue or 5 million, whichever is less. If you have this non-qualifying revenue lesser than this de minimis amount, then also the income will be considered as a qualifying income. So these are the three things that we need to keep in our mind. One is that income that you generate by selling goods or providing services to another present person, as long as that is not excluded activity. Number two is that you are providing or generating income out of your transactions with other than non-present persons, but that activity should be falling in qualifying activities and should not be part of excluded activities. If you have any other income other than this, then as long as it is less than de minimis amount, then also that income will be considered as qualifying income. So this is what it is, the main crux of this decision that is given. Of course, there are other conditions, other important rules also, but this is the important one to remember. And if you see the second box, or the non-qualifying income, which will be subject to tax at 9%. So here the thing is that this will be subject to tax at 9% without getting a benefit of 375,000 dirhams limit. Unlike mainland entity where we have this 375,000 dirhams 0% tax, that will not be given for this category of incomes. So as long as that income is falling in the category of non-qualifying income, straight away the tax will be levied at 9% on the profit. So what are those activities or incomes? So revenue from immovable property in free zone. Revenue from immovable property in free zone. The first thing is that if it is a commercial property transaction with non-free zone person, so you have a commercial property that is rented or given to a non-free zone person, then it is considered as non-qualifying income. That's one. Number two is transaction with any person for non-commercial property. So if you are letting out any other property which is not commercial property in the free zone, whatever income you generate out of that will be falling under non-qualifying income, and it will be subject to tax at 9% on the profit that you generate out of it. Okay, so commercial property transaction with a non-free zone person, other than commercial property transaction with any person, including free zone, means residential property or any other property that is given other than commercial, all those will be subject to tax at 9% since they are falling in non-qualifying income. So immovable property in the free zone, you need to be careful and see where is it falling in. If it is a commercial property given to non-present persons, the rent or whatever income you generate out of that will attract 9% tax on the profit. Or non-commercial property given to any person, including free zones, will also attract 9% corporate tax on the profit. And the second category is revenue generated from domestic permanent establishment and foreign permanent establishment of the free zone person. So you are a free zone company, but you also have a branch in the mainland or branch outside UAE, which is effectively managed from free zone. Or you have any other presence in the mainland, not through a proper license. Then if you are operating from that particular place, so that would also fall under this permanent establishment definition. So if you have that kind of arrangement, so whatever income you generate out of this particular domestic permanent establishment or out of this foreign permanent establishment, so that will be considered as non-qualifying income. That will become subject to 9% corporate tax on the profit. So you are a free zone company, but you have a permanent establishment either in mainland or either outside UAE, then whatever income you generate out of that particular domestic permanent establishment or foreign permanent establishment, that will be subject to tax at 9% on the profit. So you have to only look at that particular portion of the income and then arrive to the profit, and that profit will be subject to tax at 9% of those PEs. So let's quickly look at the activities. I know it will be a little bit confusing initially, but yes, I'll try to come back to the previous slide again just to refresh. So to my left-hand side, I have qualifying activities, and then on the right-hand side, I have excluded activities. So excluded activities are like, we can say they are the risky activities from the point of view of corporate tax are not so favorable activities for a corporate tax purpose, because the moment you conduct any or perform any explored activities, you'll be attracting this not falling into the qualifying free zone, qualifying income definition, whereby you may lose the status of the qualifying free zone persons, not only for this year, but also for subsequent 4 years. So we'll just touch base on that again. But yes, so let's start with the qualifying activities. I'll just read out for you so that you can just make a note of it for your understanding. With respect to the goods, if you're conducting any manufacturing of goods or materials within the free zone, then it falls under qualifying activities definition or list. And not only manufacturing, processing of goods or materials. So either manufacture or process of goods or materials, so they will be falling under qualifying activities list. Then distribution of imported goods or materials, either in a free zone or from a designated zone. Let me repeat, distribution of imported goods or materials, either in or from a designated zone to a reseller. Okay. So this also becomes qualifying activity. So these three are with respect to goods. Now we have second category with respect to services and of course others. Holding of shares and other securities. So you are investing in the shares of other entities. So that activity will also fall under this qualifying activities. Ownership, management, and operation of ships. So that also fall under qualifying activities. So we need to be clear or careful in interpreting our own words. So ownership, if you are owning a ship or managing the ship or operating the ship, only these three activities will fall under the qualifying activities. So if you are performing these qualifying activities, the chances for you are higher to be considered as a qualifying free zone person. Of course, there are certain other conditions to be met, but this is the main thing. And then other point is that reinsurance services, which is subject to the regulatory oversight. If you are a licensed one and then you are complying with the requirements of the respective authority, only for reinsurance services, then it falls in this. And fund management services subject to regulatory oversight again. So as long as you are licensed to do it and you're complying with the requirement of the licensing authority, then the services will fall under qualifying activities. Wealth and investment management services, again, which is subject to regulatory oversight. So that also falls under this. The next one is headquarter services to related parties. So some of the companies in free zone may have this. So you are acting as a headquarter and you are providing services to your related parties. So here they did not mention whether it is the related party to be in the free zone or outside free zone. So we assume that it is any related party, as long as you are acting as a headquarter and you're providing services of headquarter services to the related parties, then you could fall under that activity is a qualifying activity. Then you could fall under qualifying free zone person. Treasury and financing services to related parties. Again, this is for the group entities or entities which are related to, if you're providing this financing or treasury or giving some funds. So whatever income you generate out of that, that also becomes qualifying income, subject to other conditions, of course. Financing and leasing of aircraft, including engines and rotable components. So this also fall under financing and leasing of aircraft, including engines and rotable components, will also fall under qualifying activities. Logistics services. So it's only logistics services. If you're providing renting as well as logistics services, what is your primary business? So that is what you want to consider. If you're primarily into renting a warehouse or leasing a warehouse, then you may have to look at whether it falls into this or not. But if you're primarily providing logistics services and parts in that, so then that will be called as qualifying activity. The second thing that they mentioned is any activities that are ancillary to the activities listed above will also fall under qualifying activities. So this particular sentence is not very clear as to what all services or activities will be considered as ancillary to your activity. But what I understand by a reading of it is, so if you are providing the one of the qualifying activity mentioned above as your main activity. And as part of that, if you're also providing some other activities which are ancillary to your main activity, then this income also can be considered, or this activity also can be considered as qualifying activity if you are providing, or your primary activity is of any of the one mentioned above. So as long as your activity, or main activity, is one of the list mentioned above, as part of that, if you're also providing some another ancillary activity which is of minimal in size compared to your whole business, then that activity also could be considered as ancillary activity and could fall under ancillary activity to your main activity and could be considered as qualifying activity. So this interpretation, we need to look at it very carefully. Also, if we get some more guidance on this or public clarification from Ministry of FTA or FTA, then I think we need to consider that. At this moment, it's not very clear, but this is what I understand from the interpretation of it. But we just definitely need to reconfirm once we get to see more from FTA or Ministry on this particular aspect. So if you are conducting these qualifying activities, so whatever income you are generating out of that particular activity, qualifying activity, could fall under qualifying income definition. The next set of activities mentioned in the slide are excluded activities. Okay, so excluded activities are transactions with natural persons. So you are a physical person or you are a physical company and you are providing services or doing business with a natural person who is not a company. Primarily that will be excluded activity. Only exceptions are like, you are providing services related to ownership or management of a ship. In this case, even if your customer is a natural person also, it will not fall under this excluded activities. Likewise, if you're providing fund management services to an individual, or wealth and investment management services to an individual, or financing and leasing of aircraft activity to an individual. So though you are a physical company providing these services to a natural person, they won't fall under excluded activities. They are not considered as excluded activities. Leaving this, everything else that you provide, or any other transaction that you do with a natural person, will fall under excluded activities. Thereby, you may lose the status. That we will again look at. So not only that, banking activities are considered as excluded activities. Insurance activities other than reinsurance. Insurance activities other than reinsurance will fall under excluded activities. Financing and leasing activities, except financing to related parties and financing given to related to aircrafts. Other than these two, any other financing and leasing activities would fall under excluded activities. Transaction with another free zone person related to immovable commercial property other than located in the free zone. So this immovable property we have seen in the previous list. So this is referring to the same immovable property. So transaction with another free zone person related to immovable commercial property other than located in the free zone. Okay, so that also will be falling under excluded activity. And the second, the last but one is the ownership or exploitation of intellectual property assets. So if you are a software company and you have intellectual property asset, okay, so they are particularly talking about intellectual property asset, IP asset, and you are generating income out of that. So that activity or transaction also would fall under excluded activities. Any other activity that are ancillary to the activities listed above. So this is same interpretation that we discussed for qualifying activities also. So this is the list of excluded activities. If you are conducting these activities, we can more comfortably say that you would not be falling under the definition of qualifying physical person, whereby you may lose the benefit of 0% tax. So with this, let me just revisit previous slide just to refresh our understanding. So we mentioned what is qualifying income, because now if you are having or deriving qualifying income, that's when you'll be you have a chance of falling in qualifying physical person definition. So what is qualifying income? So 3 points as we discussed. So you have 3 points to consider here. First point is income from another present person except explored activities. So you are a present person or present company, you are providing service or selling goods to another present company. As long as they are not part of explored activities, they are well and good and they fall under qualifying income. So if you are a present company and you're providing a customer base is primarily of present companies only, then you only need to make sure that you're not conducting any activity which is not falling in explored activities. That's all. If you're conducting any other activity other than explored activities and your customer base is free zone persons, then you are good and your income will be qualifying income. The second scenario is income, or second category is income from qualifying activities. So you are conducting one of the qualifying activities listed. It could be to any person. The customer base could be anyone, wherever they are, but you are only providing or performing one of the activity mentioned in the qualifying activities. And they do not fall under explored activities. So you are only providing qualifying activities and not part of any of explored activities. Wherever you have your customer base, so your income will be falling under the qualifying income definition. So the other income, the third category, is only about very minimal amount compared to your total revenue, which may not fall under any of the categories mentioned above, or they have given non-qualifying revenue. And if that is either less than, your other income is less than non-qualifying income, which is not exceeding 5% of your other income, which is not qualifying revenue, does not exceed 5% of your total revenue or 5 million dirhams, whichever is lower. So that is a limit given. As long as your other income is less than that particular limit of de minimis, then that income also will be considered as qualifying income. So with this, let me just move ahead to see what else we have. So any company, they can try and assess their position by following these 4 steps, which is also used in one of the session conducted by ICAI, Institute of Chartered Accountants of India in Dubai. So these steps can be considered to assess whether your company is going to be a qualifying present person or not, just to understand your status, your company status. So first thing you need to identify is know about your company, know yourself. So know about your own company. Is your company a free zone company? Or is it a designated zone or designated zone company? Designated zone companies with respect to goods have a better chance of falling in the qualifying income. And know your customer. Second step is, so what is your customer base? So where do they locate? Are they free zone companies? Or they are outside the free zone, maybe in mainland, maybe outside UAE. And third step to see is know your activity. What is your activity? Are you conducting the activities which are falling in qualifying activities? Are you conducting your activity or performing activity which is falling in explored activities? So this is what you have to identify. And then based on that, you'll be able to understand your position, whether you'll be falling under qualifying present person status or not. Okay, so this is what you can look at. Let's quickly look at some of the scenarios or instances where, let's say, your company is a designated free zone company. Okay, and this designated free zone company is doing some transactions with another designated free zone company. Okay, so this is the first scenario here. So designated free zone company is doing transactions with designated free zone person, another designated free zone person. As long as that business is not part of the excluded activities, then the corporate tax will be 0% on that particular Yeah, on your business. You are a designated free zone person. You're dealing with another designated free zone person. As long as your activity is not an exclude activity, then for you, 0% will be the corporate tax applicable. Second scenario is you are a designated free zone person and your customer is a free zone person. So first is designated free zone person. Second one is a free zone person. So which is, what is designated zone and what is not designated free zone. Designated zones are listed down in the decision issued by the ministry again, which was relevant for value-added tax earlier. Now it is also going to be relevant for corporate tax as well. So normal free zones are other than designated free zones, which are not having any custom bounded areas where entry of goods and goods in and goods out of the zone or free zone is not monitored by the customs authority, then that is called as normal free zone. So you as a designated free zone person, you are dealing or your customer is a free zone person. Okay. As long as, again, if that activity is not falling in excluded activities, then again you'll be subject to tax at 0%. Okay. And so third scenario is you are a designated free zone person. You are dealing with a natural person. Okay. And those activities are excluded activities. Other than those four which are mentioned, we'll look into it in the future slide. Then you'll be subject to tax at 9%. You are a designated free zone person. You're dealing with a non-free zone person. Either it could be mainland person or outside free zone person, outside UAE person. And your activity is falling in qualifying activities. Okay, you are performing the activities which are falling under qualifying activities only. Then you'll be subject to tax at 0%. Okay, so all your business is falling in these activities and your customer base is this. That's when you will be attracting these respective tax rates. Okay, if you are dealing with the goods, the primary thing is to make sure that we are complying with these three conditions. One is that your distribution of goods or materials is either from in the free zone, it's happening within the free zone, or it is happening from a free zone. Let's say you are a free zone person, you have goods in designated zone and you are selling it to another person in the free zone, in designated zone or in a free zone. Okay, then it is fine. It will still fall under this, satisfy the condition of qualifying activity. Not only that, if you're selling it to a mainland entity, so primarily your sales should happen within the free zone, so that the mainland person should take the delivery from free zone. And for you, your goods are moving out from free zone itself. So the origin of the transaction should be from free zone. So this is one condition that we need to comply with if you want your activity to be considered as a qualifying activity. Not only that, your customer should be a reseller. Either he resells that particular product directly as a trade, or he processes the goods or material and then sells it. Okay, so this is the second condition that is to be met. The third condition is that goods or material entering must be imported through designated zone. If you are importing from outside UAE, you are a free zone company, it should pass through designated zone. Then only you'll get the benefit of this qualifying activity and will be falling under qualifying income. Okay, so these three conditions should be met with respect to goods to be considering under this distribution activity. I'm just taking you through the previous one. So one of the activity as part of the qualifying activity for goods was distribution or import of goods or materials either in or from a designated zone. So distribution includes even trading also. So you're a trading company into goods or material and you're a free zone company. As long as those goods are in designated zone or being sold from designated zone, and you're selling it within the designated zone, or your selling is starting from designated zone, and you're selling that to a person who is a reseller directly or process it and resell it. So as long as these conditions are met, then that particular transaction will fall under qualifying activity. Thereby, you will get a benefit of qualifying income and 0% tax. So let's quickly look at the services activities. So we have seen goods activities. So let's now see or look at the service activities. If you're a free zone company and you're providing services, what is the status you're going to be? So free zone person, including designated free zone persons. If your customer is a free zone company, another free zone, it could be in the same free zone, another free zone. Let's say your service activity is falling under any of the excluded activities, which we have seen already. Once it falls under excluded activities, so you will be subject to tax at 9%. And second scenario is that you are a free zone company and you're providing services to another free zone company, but your activity is not an excluded activity. Okay, it need not to be part of your qualifying activities, but it is not falling in excluded activities. Then your profit will be subject to tax at 9%. Third scenario is that you are providing services to a natural person. Okay, and that activity is falling under excluded activities, other than those 4 exceptions that we have seen. So then it will become a 9% taxable profit. Because the moment you're falling in this excluded activity, so you'll have to remember that it is going to be 9% tax. If you're providing services to a natural person and that activity is falling under exceptions mentioned for excluded activities, then it will be 0% tax. You're a free zone company and you're providing services to non-free zone person, let's say mainland company or outside UAE company. As long as your activity is a qualifying activity, like logistics, headquarter services, etc., then your profits will be subject to tax at 0% tax. You'll be falling under qualifying person as long as you meet other conditions also. This is only from the point of view of taxation that could apply to you, but you also need to meet the other conditions to be considered as a qualifying free zone person. Like we have seen, you need to maintain substance in the free zone. You need to get your books of accounts audited. You need to derive income, which is a qualifying income, and you are also complying with the arm's length principles and transfer pricing requirements. And one more condition that is mentioned. So as long as you comply with those conditions and you conduct these activities to this customer base, then these rates will be applicable. So we have so far we have covered qualifying free zone persons. So quickly I'll finish the few other concepts related to free zone persons, and then I think we can get into Q&A session. So a small business relief, this is applicable for most of the SMEs where the turnover of the company is less than 3 million dirhams. And once you opt for that, if your turnover is less than 3 million dirhams, and if you opt for that small business relief, then you will be getting a benefit of no tax on your, your tax, your profit will be subject to tax at nil. Okay, so your turnover for the year is less than 3 million. It's not exceeding 3 million or less. Then your business can go and opt for the small business relief, whereby the tax to be paid on your profit will be nil. Okay. So the other conditions with respect to this is that this relief is given only for the period of 3 years, like until 31st December 2026. So this is going to be applicable for the financial years which are ending on or before 31st December 2026. So after this, whatever business income you have, whether it is 3 million or less, you'll still be subject to tax in the normal way. Okay, unless the ministry comes up with another extension, this is what it is going to be applicable for you. The second condition is that it's not only for that particular year. Your turnover should be less than 3 million dirhams in each of the years to get the benefit of the small business relief. So let's say in 2024, you had 2.5 million dirhams as your turnover, whereby you opted for small business relief because it is less than 3 million dirhams. Your turnover, I'm talking about sales, total sales or total income to be specific. So that is less than 3 million dirhams, and then you opted for that. So there's no tax on your profit for 2024. In next year, 2025, let's say that your total revenue is 4 million dirhams. So which is more than 3 million, right? So since it is more than 3 million dirhams, so you are not eligible to claim this small business relief in 2025. So only 2024 you did. In 2025, you're not eligible to do it. Let's say in 2026, your turnover is again 2 million dirhams now, which is less than 3 million dirhams. Then the question is, can I opt for this small business relief? The answer is no. The reason being, in 2025, which is a preceding year or previous year to 2026, you had a revenue more than 3 million dirhams. In which case, in that particular year, as well as for the following years, you will not be able to claim or get the benefit of small business relief. Okay, so this is what is the very important thing to look at. So how do you compute your books or total income? So this will be computed or arrived to based on your IFRS, International Financial Reporting Standards. Based on the accounting standards under IFRS, you have to compute what is your total income and then compare with your small business relief threshold. Okay, so this is about it. So key takeaways from this session, the slides that we have gone through. So withholding tax, foreign tax credit, which we have seen already. And you have to record those transactions separately to be able to claim the benefit of your withholding tax or foreign tax paid. You have to look at any of yours, your business or any of your group business fall under small business relief. Do you want to club this as part of group or not to get the benefit? That's what you have to look at. Also see whether you have a free zone entity or mainland entity, or you have free zone entity as well as mainland entity, or businesses are operated in both the places. How do you have to have your separation, and which one is going to be more beneficial? All those things you need to look at. If you have any entity outside UAE, record the transaction with respect to that outside UAE entity so that your foreign tax credit can be claimed properly. So this is another major topic that I'm not going to cover much on this, related party transactions. Just to give a brief, a natural person having investments in a juridical person or having control more than 50% of the company, then the natural person will become a related party to the juridical person or to the company. So not only that, if a company A is investing in company B, so the company A and B become related parties, or company A is investing in company B and C, and these three companies together become related parties. Not only investment, but if you have control, which is majority control, which is 50% or more control or 50% or more ownership, then it is they are called as related parties. There's a concept called connected persons. This is not very common in most of the corporate tax countries, but here, since we don't have individual income tax, so they had to bring in this connected persons concept. So the owner of the company, directors of the company, or officer who is a responsible position, plus their relatives, all these become connected persons to the company. An owner, a director, or an officer, plus their relatives also, or related persons also, parties also, become related parties to the company. Okay. So when I say related parties, so which level of who all will be falling under that definition? So they mentioned clearly that it is going to be fourth degree of kinship is what they look at. Means 4 generations up and 4 generations down will be considered for this related party. So if you are a director and of a company, and you are this 4 generations up and down will be considered as related party for that particular company. So any transaction that is done with related parties or connected persons will have to be looked at carefully and make sure that that is at arm's length or that is at market value. So just to give one example, company A, let's say company A is selling a product and that product is sold to company B, which is a third party, not connected to company, that is selling at 20 dirhams. And the same product by company A is sold to company C, which is a related party. Let's say they are selling it at 10 dirhams. So company A is selling that product to company B at 20 dirhams, which is not a related party. The same product is sold to company C, which is a related party, at 10 dirhams. So there is a difference in the prices. Though let's assume that the product is same during the same period under the same conditions, but your price is different. So this should not be the case. Whether you're selling it to your third parties or customers, whether you're selling it to your related party. So the price should be at market value or at arm's length. So that is what we need to make sure. As long as you have any transactions with related parties and connected persons, you need to make sure that they are at arm's length. Not only that, you have to make sure that they are arm's length and demonstrate also. How do you demonstrate? So you will have to have documentation to demonstrate that. There are various methods to arrive to, and how do you demonstrate that? I'm not getting into the details of that. So there are 6 methods to arrive to this arm's length price or benchmarking price. Based on this, you can arrive to that. So these all could be the transactions that you may have with your related party. Company can have these kind of transactions with related parties. So if you have any transactions sitting in any of these or falling in any of these, better you need to be careful to look at it and then see whether you are pricing that at market value or not. And do you have to comply with the requirements of documentation, additional documentation and benchmarking and all those things. You are providing services to another company which is part of your group. It could be IT services, ITS, or sales. Are you selling goods to a related party or buying goods from related parties? It could be domestic or it could be outside UAE. Are you using or selling or transferring a tangible property or finance arrangements? So intangible properties are given. So all these transactions, whatever I listed here, would fall under a transaction that could be with related parties if you're doing it. So these are the common transactions that you could have with related parties. So if you have this, you need to be careful and you have to come up with your documentation. We have a specialized team who can help you on these particular transactions, benchmarking as well as documentation and creating policy for your company so that you can be rest assured of compliance. So these could be the transaction that you may have with your connected persons like owners, directors, and the officers plus their related, like salary, you may pay or rent, or perquisites, or you may pay interest on loan given by the owner. So these transactions, if you have, you need to be careful. It's very difficult to come to the market value or the arm's length of salary payment to the owners or interest payment on the loans given by the owners. So it's not very easy. It's a challenging task to have the benchmarking of market value to come up to. So you need to be careful in doing that. I'm not going to look into this. There is some additional documentation to be complied with if you have a transfer pricing documentation requirement. Only if you are, otherwise also you can maintain, but for this category of companies, it is mandatory for them to maintain. If you are part of a group which is having 3.15 billion dirhams turnover or more as a group for the year, then you are expected to comply with this additional documentation of transfer pricing, like maintaining a master file and local file. Not only that, if you are an entity and having a turnover of 200 million dirhams or more, then also you're expected to maintain this master file and local files as a mandatory. So the authority can ask you to submit them, but you have to maintain them to be ready to be able to submit to the authority whenever they ask. So the last leg of the session, which is about the CT administration, let us quickly look at that. How and when we have to really register all the taxpayers in the company and the country, irrespective whether you have profit or loss, whether you have turnover or no, you are supposed to register for it. And you have to register before you file your first return. Before you file your first corporate tax return, you have to register yourself. So that is the deadline. A certain category of companies, they have given dates before that, but for general or regular companies, this is what it is. There's no registration threshold given, unlike VAT. So whether you have no revenue or don't have revenue, profit or loss, as I mentioned, so you have to register for your company as for corporate tax purpose. And it can be done electronically. The same MRR tax is what they are using it for. So from there, you have to register. Corporate tax returns, how and when we have to file. So we will be filing on one corporate tax return for the period. When I say period, it is going to be generally year, unless you have part of the year in unusual circumstances. So for 1 year, one corporate tax return, no quarterly, as well as you have to file the corporate tax return within 9 months from the end of the financial year. Like Manish mentioned earlier, so you are given sufficient amount of time to file your corporate tax return, which is 9 months from the end of the financial year. If your first financial year is, let's say, corporate tax period is, let's say, 1st January 24 to 31st December 2024. So after 31st December 2024, you have time till 30th September 25, 9 months after financial year, to file your corporate tax return as well as make the payment of your tax. So that is sufficient amount given by the FTA ministry to file your corporate tax returns. There's no advance tax to be paid. The tax will be paid like how we are paying that amount after the financial year ended, before 9 months. It's again going to be through MRR tax. So this is how these are the elements in your corporate tax return that could be there. This is prepared based on the provisions that are available in the decree law. So here one important thing to note is that your base is going to be your accounting profit. Whatever profit you arrive to based on your books of accounts that are prepared by following IFRS will be the basis to start your computation for corporate taxes. So this profit, as per your books of accounts, will be adjusted based on the deductibility or non-deductibility of expenses, as well as other adjustments that are expected from corporate tax law. Like we have seen, the donations, grants or gifts given to entity which is not part of the cabinet decisions list given as public qualifying benefit entity. And if you have any fines or penalties, not for compliance of not for non-compliance of the law, so they could not be allowed as deduction. So we have to add it back. Why are we adding it back? Because the profit base that we considered is the profit as per books of accounts. In that profit, you must have already deducted this fine because it is for business. Since you already deducted, but it is not a deductible expenses for corporate tax, we are adding it back to arrive to your taxable income. So likewise, other amounts also you will have to either deduct or add. Then you arrive to the taxable income. On that taxable income, you will be computing your tax payable amount by looking at either 0% or 9% or 0% up to 375,000 dirhams and 9% in excess of that. So that's how you will compute. And to that tax payable amount, you make other adjustment of withholding tax or foreign tax credit or any other reliefs that are available. All that will be deducted, and then we'll be arriving to the net amount of tax to be paid. This is how it will be done. So how do you, what is the requirement of record keeping and making audits? So they say that you have to maintain books of accounts at least for 7 years after the end of the financial year, which means effectively it is going to be for 8 years. You have to maintain books of accounts. Who should maintain books of accounts? Everyone who is taxable, including exempted persons, should maintain their books of accounts. And with respect to audit, what is the mandatory to get the audits? You can get your books of accounts audited anyways in general, but for corporate tax purpose, if your company's turnover is more than 50 million dirhams, your turnover revenue, then it is mandatory for you to get your books of accounts audited for corporate tax purpose. And every free zone, a qualifying free zone person, like we have seen, should also get their books of accounts audited. So generally we follow IFRS and we follow accrual method of accounting or basis of accounting, but a certain category of companies, they have given that they are allowed to maintain the books of accounts on cash basis of accounting. If you have revenue that does not exceed 3 million dirhams, then you can go for cash basis of accounting for corporate tax purpose. And in exception circumstances, wherein if you apply to the FTA and they approve it, that's when you can go for cash basis of accounting for your books. Otherwise, you are expected to follow IFRS and accrual method of accounting. And like I was referring earlier, accounting standards that are expected to be followed in UAE for corporate tax purposes, IFRS, International Financial Reporting Standards. If your turnover is less than 50 million dirhams, then you can go for IFRS for small and medium enterprises, which is little limited than full IFRS. That is your choice. If you want to maintain full set, you can just comply with full IFRS. Otherwise, it is IFRS and SME if your turnover is less than 50 million dirhams. I'm not touching the group we already discussed. So there are certain transitional rules. I have not considered few of the other transitional rules that are mentioned, but the overall the expectation is that you have to update your books of accounts even for opening balances. Like if your first financial year is 2024, even your 2023 closing balances should be looked at and reviewed, especially for the transactions that you have or balances that you are payable to related parties, should be updated as if you already complied with the transparency rules and you have the transactions at arm's length. So 2023 numbers also you need to look at if your first tax period is going to be from 24 onwards or whatever it is. But the opening balances for taxation period should be looked at and reviewed. Make sure that you don't have any other provisions or accruals which are not relevant, advances which are no more receivable, or whatever you have. So just review all the numbers of balances in your balance sheet. Make sure that you're getting into tax regime with a clean records. But for related party transactions and balances, you should update your closing balances of previous period as if you've already complied with the requirement of the law. There's a specific section of rules given for anti-abusive rules. That also you need to make sure that you're complying with that. What is anti-abusive rules? General anti-abusive rules, which are called as GAR. So here the essence of it is that if you are coming up with any new arrangement or your new business structure, and you're doing this after the decree law has been released, after that period, if you're doing any of these changes with the sole objective of reducing the tax or saving the tax or minimizing the tax, then that is not allowed. But in addition to that, you have a commercial reason to go for that change. Okay, you are bringing up with some change or coming up with some change in your business structure, or the way you conduct your business with a commercial reason to do that, then it is fine. But if you don't have commercial reason to do that particular change or arrangement, if FTA comes to know about that, then they can ask you to reverse the effect, and you will be subject to tax as if you don't have any benefit of that particular change or arrangement. So this is very important to look at if you are coming up with any changes to your business structures and all those planning. So if someone wants to have assessment of their corporate taxes, we can do in this. So we can do in this steps like we do a high level of impact assessment, and then we do detailed assessment of your company, and then we come up with your implementation by coming up with more precise changes to be done or whatever is required. And then we also will be with you for in the course of your tax year as well as for filing up for the returns. These are the few important areas to look at for your planning or being ready for your corporate tax period. So these are the areas that we already discussed and touched base on. This is what I just wanted to let you know about this. The one important thing that we did not see is that we also conduct trainings for your teams if you want. This is going to be exclusive training for company's team, so that it can be specific to your company business. And as I mentioned, we also perform other assessment and implementation help. We have a specific team which is working on transfer pricing and international taxation, which has got a rich experience in that, working with Big Four and working for last 10 to 12 years on this, precisely 7 to 8 years on this in India for other global companies. So with this, I think we reached to the end of the session. And I request you, if you have any questions, I think we are left with another 10-15 minutes. We are happy to answer your questions. If your question is not answered, then you can always reach out to us on this number or on the email ID mentioned there, which is info@spectrumaccounts.com, or you can always refer to our website, spectrumaccounts.com. So we publish various blogs as well as videos, so you can refer to our website whenever you have anything on corporate tax or on value-added tax. So I request you, if you have any question, so Manish is here with me. Also, I can answer if you have any question. So just, yeah.
Hello, sir. We have received one question from one of our members that what are headquarter services exactly? What are the activities included in headquarter services?
Yeah, so headquarter services, they have not defined it clearly in the decision. But in which case, I think we may have to just look at it from the other available laws within UAE. I think ESR, Economic Substance Regulation, to some extent considers this. Headquarter services is one of the relevant activity mentioned in that. So you are in headquarter and providing services to your entities, related parties. And it could be your management sitting here and providing services. And strategic decisions with respect to that particular entity are taken from here. And to this, towards this service, you're providing, you're raising invoice and then you're getting income out of that. So that's what I understand out of this ESR. So you are primarily guiding and being mentoring to conduct the business, or you taking decisions from this company and acting as a headquarter for that particular company. So that's what is headquarter services.
Next question here we have is if the company is exempted for VAT, do they still have to add back input VAT which is not claimed?
Manish, you want to take? Manish will take.
Yeah. Okay. So the question here is that if you are exempted from VAT, so if you are exempted from VAT, then you are not claiming, so your input VAT, which you cannot adjust from your output VAT because you're not going to charge output VAT as you're exempted. Then in that case, whatever input you are paying VAT, so you can claim because that is not recoverable anyway because you are not paying any output VAT. So the input amount, like for your expenditures for telephone or any kind of fuel bills or whatever, any of the expenditures being incurred and you're paying VAT on that, you can claim as a deductible expenditure. So you don't have to add back. You have already computed your accounting profit on which you would have deducted that. So you can continue deducting it because you are already exempted from VAT and you're not paying any output VAT. Hope this addresses your query.
So
we are having some frequently asked questions also over here. Is the corporate tax registration mandatory for a natural person or a freelancer conducting business activities?
Okay, with respect to the corporate tax registration, yes, it is mandatory for even natural person. But then, as I mentioned, like there are three categories of income. If you're earning salary income, then you are exempted from corporate tax. Or if you're having a personal investment income in the share market, stock market, you are exempted. Or if you're having a real estate income on rental income, then you are exempted on these three categories of income. If you are earning anything in an individual capacity, you are not you do not pay the corporate tax. You're exempted, and then you do not register for that. But if your income is other than that, like your business advisory services or freelancing consultancy services, and if it exceeds 1 million, if your revenue is going to exceed 1 million, then you need to register and pay corporate tax. So up to 1 million, you are exempted. You can call as an exempted yourself, and you did not register for corporate tax.
Thank you, sir. Another question we are having here is we are in a mainland company, which is we're in a tourism business, selling 90% of business outside UAE only. So is this income from outside and is taxable? Is this taxable?
Tourism company in the free zone, you say?
No, they are in mainland.
They are in mainland. Generally, for mainland companies, the income is going to be taxable. the same rates will be applicable like 0% on your profit up to 375,000 dirhams and 9% in excess of that. That's the general thing. And one important note I just wanted to make here is that we are only trying to make the law a little bit simpler to you, but whatever conclusion you have to make, so you need to relook at the law as well as the decisions and come to the conclusion, because our interpretation to some extent in some cases based on the facts of your company may or may not be relevant. So you need to look at that, the facts of your case, also the other relevant sections of the law, and then conclude on that. We are only just trying to give a brief idea of what has happened so far.
Thank you, sir. So another question here is, for small business relief, can we take up a separate license within the existing business to transfer the business up to 3 million dirhams? And to take the small business relief, can we take up separate license to transfer this benefit which is given by the government? Can we take up a new license for this in the existing business? And also, is this automatic, or we need to apply for it separately?
Okay. Thank you, Pratiksha, for this question. So what I understand from this is that if there's a small business relief, under the corporate tax where up to 3 million revenue, if it is revenue up to 3 million, so you can apply for this corporate. So you have to separately apply for this corporate tax, relief, small business relief, wherein you won't be paying corporate tax. But then there are certain conditions, as Balaram have mentioned, that you cannot carry forward tax losses and other criteria which you may lose out for applying this benefit. And the next question, which I understand, that if you want to separate a business to benefit out of this 3 million, so then there comes the general abusive rules, as Balaram was mentioning about it, that you cannot do that separation of a business out of an existing business to claim this benefit of 3 million. But you'll have to see and there has to be a commercial reason justifying that why you are separating that business. It is having a commercial sense, a commercial business activity which you want to separate. So it is case to case, you need to analyze. But upfront, if you see, you cannot do that, because in the past you have been doing in a common activity, but it has to be analyzed on case to case basis to see if it is making a commercial business sense to have a separate trade license to carry out up to 3 million activity.
Thank you, sir. Another question here is, the company has an activity which is not defined either as a qualifying or excluded. And he's asking for a confirmation that whether the corporate tax which would be applicable for him is 9% or 9%, even if all the other requirements of corporate tax are met, or it will be 0%.
Yes, so here, if you're not satisfying the requirements of qualifying prison person, or you do not have a qualifying income from the activities that I mentioned, then you lose the benefit or status of qualifying prison person. Once you lose the status of qualifying prison person, for that year, as well as for the subsequent 4 years, you will not be allowed to claim or go for this status again. So in which case, so you will be subject to tax at normal tax rates of 0% up to 375,000 dirhams and 9% after that 375,000 dirhams, though you are a free zone company. So that's what we need to look at. So always we have to see whether we are complying with the requirements of the qualifying prison person. One of the important one being qualifying income. So your income, is it falling under that qualifying income or not? Then based on that, you will have to decide which rates will be applicable to you. I hope that answers the question.
Thank you, sir. Next question here we are having is they are registered in a free zone and they are having earnings from both mainland and abroad from that is from out of UAE. So is this and they are providing digital management services. So are we eligible for qualifying free zone?
I think it is similar to the question that we had earlier for another one, wherein they have a client base in mainland. So whether it is along with the free zone company, whether it is free zone, mainland company or the customer base is in mainland or outside UAE. Okay, so as long as that is not falling in the qualifying activities, it's just for the reference purpose. Let me share this qualifying activities list. You're able to see this screen? Yeah. So if it is not falling in any of these activities mentioned in qualifying activities, okay, then you may not fall under this. You may not have your income may not be considered as qualifying income, whereby you will not get the status of qualifying free zone person. So here for this free zone purpose, the rules are not very straightforward, that I understand, and even the law also is evolving, as well as we are also trying to understand it more and more. But whatever conclusions we are coming to is based on the limited interpretation and limited data that we have. But most of the times what happens is that we may think that whatever business we do in the free zones will be subject to tax in whichever way we do it. That was the understanding so far, but that's not the case. Most of the services will have to look at their company, will have to look at their customer base, will have to look at their activities, and then come to conclusion. Most of the services will not have or will not get the benefit of this 0% tax unless they comply with these requirements. Yeah, I think for them it may not, unless their income that they generate from the free zone entities is very significant, and then the income from their outside UAE clients are less than the de minimis mentioned, because their activities are not falling in qualifying activities. They only have to look at the second activity, where if they do transactions with non-free zone entities and not part of excluding activities, that could fall under the qualifying income. But because that is not falling in this definition of qualifying activities, the activities that they're conducting are not part of qualifying activities. Only first rule will be applicable for them if they want to be considered as a free zone person, wherein your income is coming from another free zone person, and that's not other income is not subject to de minimis threshold. So which means you have a significant portion coming from your clients within the free zone. That's when you will be getting the status of qualifying free zone person, subject to meeting other conditions.
Thank you for the clarification, sir. Moving to another question. The company is located in a free zone and having trading activities of oil and gas purchasing from UAE free zone companies as well as from foreign companies. And they are selling it to outside UAE companies. So in this case, will they still be covered under 0% tax regime?
I think for this, one important thing is to see whether that company is designated zone or not. Second thing is the goods that they are trading in. So buying, it could be from anywhere, but when they sell it, is it within the designated zone, or is it beginning from the designated zone, moving out to outside or moving to mainland? So if that is satisfied, it could fall under distribution of goods, which is one of the qualifying activities. Okay, so if your income is coming from that, you being a free zone person and you conducting the qualifying activities, so this income will be classified as qualifying income. And then subject to meeting the other conditions of qualifying free zone person, so you could fall under this 0% regime. So unless you have this particular thing, okay, so the goods primarily should be either sold within the designated zone or should be sold from designated zone. Okay, so the other way to say is that if you are buying from outside UAE and selling it outside UAE itself, that activity will not be covered under this distribution activity of qualifying activities. So the goods physically should be in designated zone when you sell it. So either you sell it within the free zone or you sell it to outside. Further, your customer also should resell it. So that is another condition to be met. So you are selling it to another reseller or a customer who is going to process it and resell and sell it. So if these conditions are met, then your activity will be falling under qualifying income. Yeah.
Thank you, sir. Moving further, will GAR apply if the company structure is restructured in order to form a tax group?
Can you repeat the question?
Will GAR provisions apply if the company is restructured in order to form a tax group?
So that's, I think, one of the conditions given. If you have a reason, so there's a reason to do it. And to form a group, if you're changing your financial year or some other related provisions, then that may not fall under GAR. So though you are trying to get the benefit, but that's within the rules of the corporate tax. I don't think then it will fall under that. Just note person's. Just make a note of the query person raised by whoever it is. We'll get back to him if there's any contradictory to this.
Thank you, sir. So the next question here is, in VAT, the name and name of the company, address, and TRN must be specified in the invoice for us to collect input VAT. Is this also true for corporate tax? I think they are having a confusion whether corporate tax is a direct tax or indirect tax. I think they are thinking that corporate tax is to be collected from the customer, it seems.
Yeah, so the primary difference is that corporate tax is direct tax and value-added tax is an indirect tax. So as you know, the value-added taxes is levied on the sales and it is charged to the customer. So you are collecting it from customer and paying it to government after adjusting your input tax credit. So it is indirect tax that you are only facilitating in collecting the tax amount to the government, whereas corporate tax is a direct tax. So it is levied on your profit after making certain adjustments, which will be paid out of your funds. So it is a direct tax on the company's profits.
Okay, Pratik, just to add on to this, I think the question was also inquiring whether the invoice should also mention about the corporate tax number. As in the VAT, we mentioned the TRN number on the invoice, but because it is on the business income and it is not on the sales, it is the income which on which you are going to pay corporate tax. It is on the annual return only on the annual return you have to mention about your corporate tax registration number. So it is not on the invoice. You need not mention your corporate tax registration number on the invoice. Only the VAT TRN number has to be there on the invoice.
The cap on salary drawn by the directors, partners, and owners of the mainland company.
Yeah, so for any company, whether it is mainland or free zone company, they have not mentioned any cap on that, like we have it in the case of interest expense. So all that they mentioned is that whatever payments you make to any of the connected persons should be at market value. So which means it should be at arm's length. The other way to say is that if those services under the same conditions with similar amount of experience for a same size of a company in the industry, if you employ a third person, how much would you pay to him as salary? So that's what is the simple plain term of explaining arm's length amount of salary. So how much salary would you pay to that third person if you employ a third party? The same amount of or in the range of that amount should be shown as salary. If any amount in excess of that, if you have accounted as expense, when you compute your taxation, you have to make an adjustment by adding it back. So this is what falls under this transfer pricing and arm's length pricing requirements and documentation. So they have to make sure that they have sufficient amount of documentation to substantiate, to say that this is arm's length price, or this is at arm's length, or this is at market rate or market value. So that's what is important, which generally is not a cup of tea of every consultant to do it. There are some people who are having experience to do this kind of documentation and come up with a policy. So if you have significant amount of expense or transactions falling under this category, so it is always advisable to get the service of the expertise or experts on this. As I mentioned, so we have a team who can help on this transfer pricing and international tax planning. So definitely we can help on coming up with the market value for this.
Thank you. Moving further, a company is located in DMCC, and is the bill to ship transaction taxable if the goods or the services does not reach to UAE? Is that taxable?
I think you are saying that if you have purchase of goods which are in transit outside UAE and they are sold while they are in transit before they reach UAE, so that is nothing but the high seas sale. So since the goods are not either moving out from designated zone, if you are a free zone company, and since the goods are not coming, goods were not in the designated zone physically, so that will not be falling under the qualifying activity, whereby you will not get the benefit of the 0% tax on that. You will be subject to tax at normal rates of 0% up to 375,000 profit and 9% in excess of that. Okay, so I think we already crossed the time, and you can leave your email if you have, if you want. I think we already have our email IDs of yours. We will try to share our presentation as well as the video to your email if you want. And if you have any more questions also, you can definitely send your questions to our contact details, info@spectrumaccounts.com. I'll just share the screen. So info@spectrumaccounts.com. See. Yeah, so these are our contact details. So you can reach out to us anytime, and we can definitely help you in resolving that. So just to add, we provide audit, accounting, and VAT services also. In addition to that, we provide company formation services, and then of course transfer pricing services and international taxation also. Corporate tax definitely will do that. So these are the services that we do. So you can reach out to us for any of the other services. And if you have not addressed any of your question, we'll try and answer your question directly by taking your details from the chat and reply to you or reach out to you. So with this, I think I would like to end the session. Thank you all for attending the session. We hope that we added some value to your understanding of the law, and we are here to help you more to comply with it. Thank you.